How to optimize algorithmic trading for ETFs. Introduction: Algorithmic trading has revolutionized the way investors approach the financial markets, particularly with exchange-traded funds, ETFs. ETFs offer a versatile and efficient way to gain exposure to a wide array of asset classes, sectors, and geographies. However, maximizing the potential of algorithmic trading in the ETF space requires a sophisticated approach. Traders often grapple with challenges such as concentrated risk, liquidity issues, and unanticipated correlations between assets. These challenges can erode profits and increase volatility, undermining the advantages that algorithmic trading promises. In this video, we will delve into 3 key strategies to optimize algorithmic trading for ETFs: diversifying intelligently, leveraging liquidity, and monitoring correlations. By focusing on these areas, traders can enhance their performance, manage risks effectively, and capitalize on the diverse opportunities that ETFs provide. Strategy 1. Diversify intelligently. Use algorithms to capitalize on the variety of ETFs available. Diversification is a core principle in investment strategy, and when it comes to ETFs, it's crucial to implement it intelligently. Simply spreading investments across multiple ETFs isn't enough. The goal should be to create a portfolio that is well diversified across different asset classes, sectors, and geographies in a way that maximizes potential returns while minimizing risk. Algorithms play a pivotal role in achieving this by analyzing vast amounts of data and identifying ETFs that align with these goals. Example 1. Let's consider a scenario where an algorithm is tasked with creating a globally diversified ETF portfolio. Instead of just selecting US-based equity ETFs, the algorithm might allocate capital to ETFs that cover various international markets. For example, it could include an ETF tracking the MSCI Europe Index, another tracking the MSCI Emerging Markets Index, and a third focusing on US small-cap stocks. By diversifying across these geographies, the algorithm reduces the portfolio's exposure to risk specific to any single region. If the US market underperforms due to domestic economic issues, gains in European or emerging markets could potentially offset those losses, stabilizing the portfolio's overall performance. Example 2. Consider another scenario where an algorithm is designed to create a sector-diversified ETF portfolio within the US market. Instead of concentrating on just 1 or 2 high-performing sectors like technology or healthcare, the algorithm selects a mix of sector ETFs, including those focused on energy, consumer staples, and industrials. Each of these sectors responds differently to economic cycles and events. For instance, consumer staples might perform well during an economic downturn, while technology and energy could excel during periods of economic growth. This intelligent diversification across sectors ensures that the portfolio is not overly reliant on the performance of a single industry, reducing overall risk and smoothing returns. Strategy 2. Leverage liquidity. Choose ETFs with high trading volumes for smoother execution. Liquidity is a critical factor in the execution of algorithmic trading strategies, particularly in the ETF market. High liquidity ensures that trades can be executed swiftly and at prices close to the current market value, minimizing slippage and maximizing the efficiency of the trading strategy. Conversely, low liquidity can result in wider bid-ask spreads, making it difficult to execute trades at desired prices and potentially leading to increased costs or losses. Example 1. Imagine you're running an algorithm that trades large positions in the SPDRs and P500 ETF, SPY, one of the most liquid ETFs in the world. SPY regularly trades millions of shares each day, with a narrow bid-ask spread, meaning the price difference between buying and selling is minimal. Because of this liquidity, your algorithm can execute large orders quickly without significantly moving the market price. For example, if the algorithm identifies a profitable trading opportunity and needs to buy 10,000 shares of SPY, it can do so almost instantaneously, ensuring that the trade is executed at a price very close to the current market rate. This high liquidity allows for precise execution, reducing the risk of slippage and enhancing the overall profitability of the strategy. Example 2. Now, Consider a different scenario where the algorithm is trading a niche ETF, such as an ETF focused on a specific emerging market or a sector with low trading volumes, like a specialized biotechnology ETF. These ETFs might have much lower average daily trading volumes, leading to wider bid-ask spreads. For instance, if the algorithm tries to buy 5,000 shares of this biotech ETF, the lack of liquidity could cause the price to rise sharply as it buys, or it may take longer to find sellers willing to sell at the desired price, leading to slippage. This slippage can eat into profits or even turn a potentially profitable trade into a loss. Therefore, to optimize trading efficiency, the algorithm should prioritize ETFs with higher liquidity, especially when dealing with large trades or when operating in volatile markets. Strategy 3. Monitor correlations. Be aware of underlying asset correlations to manage risk in ETF-based strategies. Correlation between assets is a crucial aspect of risk management in any trading strategy, especially when dealing with ETFs. Correlations measure how closely two assets move in relation to each other. Understanding these relationships allows traders to construct portfolios that are not overly exposed to the same risk factors. When two ETFs are highly correlated, they tend to move in the same direction, which can increase the portfolio's overall risk. By carefully monitoring these correlations, algorithms can help manage risk by ensuring the portfolio remains diversified and resilient to market changes. Example 1. Consider an algorithm that trades both an energy sector ETF and a consumer discretionary sector ETF. At first glance, these might seem unrelated. However, the underlying assets in the energy ETF, like oil companies, can have an inverse correlation with those in the consumer discretionary ETF. When oil prices rise, energy stocks often perform well, but higher energy costs can hurt consumer discretionary spending, causing the consumer ETF to underperform. If the algorithm detects that the inverse correlation between these two ETFs is weakening, perhaps due to macroeconomic changes like a shift in consumer behavior or energy market dynamics, it may adjust the portfolio by reducing exposure to one of these ETFs or by introducing a third ETF that is less correlated with either sector. This adjustment helps to maintain the portfolio's overall diversification and manage risk effectively. Example 2. In another example, suppose your algorithm is trading a portfolio of ETFs focused on different regions. Say, a US equity ETF, a European equity ETF, and an Asian equity ETF. Historically, these ETFs might have had low correlations, as their underlying markets react differently to global events. However, during periods of global economic turmoil, such as a financial crisis, correlations between these regions can increase as global markets tend to move in tandem during crises. If the algorithm detects an increasing correlation among these ETFs, it might respond by reducing overall equity exposure or by adding assets that historically have low correlations with equities, such as government bonds or gold ETFs. This proactive adjustment helps protect the portfolio from potential synchronized downturns across multiple regions, thereby managing risk more effectively. Conclusion: optimizing algorithmic trading for ETFs involves more than just executing trades. It requires a strategic approach to diversification, liquidity management, and correlation monitoring. By diversifying intelligently, you can spread risk across a variety of asset classes, sectors, and geographies, enhancing the stability of your portfolio. Leveraging liquidity ensures that trades are executed efficiently, minimizing costs and slippage. Finally, by monitoring correlations, you can manage the interrelationships between different ETFs, reducing the risk of correlated losses. These strategies, when combined and implemented through sophisticated algorithms, can significantly improve the performance of your ETF trading strategy, leading to more consistent returns and better risk management. As the ETF market continues to grow and evolve, staying ahead of these challenges with a well-optimized algorithmic trading approach will be key to achieving long-term success.